Good morning, everyone. Thanks for joining for today's Economic and Investment Outlook. Today we're joined by Chamath De Silva, our Head of Fixed Income. Thanks, Cham. David Bassanese unfortunately couldn't make this one, but fortunately a very adequate step in, and particularly given what's going on in bond markets at the moment, could get some really good insights today from our Head of Fixed Income, Cham. Before we do kick off the webinar, just some important disclaimers. So all of the information we give today is general in nature. We're not taking into account any of your personal circumstances as we do not know them. Before we start, just on the actual webinar functioning itself, we will send a recording of the session afterwards to all of the attendees, and if you signed up for the webinar. And during the webinar, feel free to ask questions in the question box down in the bottom right-hand corner. We'll have time at the end to address some of the more common questions we get throughout the webinar. And finally, just worth mentioning, we have a lot of regular content we put out. Myself and Cham both work on a lot of written pieces that go through our blog, for instance. So you can sign up for that on our website and find our insight pieces via betashares.com.au. And finally, just about Betashares a little bit. So pretty proudly Australian found and still functionally owned ETF provider. We've grown to over $30 billion in assets under management now with 80 different funds, and probably something we're even more proud of is we're servicing 1 in every 10 Australian investors, so 1 million Australian investors now. So really proud of our growth and the support we get from our clients, so thank you. In terms of what we'll be covering today, we're going to start with the Australian economy, start here at home. Then we'll talk a bit about the US and what's going on there, a bit of this miracle on Wall Street chat, and then finally bring it home to some investment implications. And as I mentioned, we'll have time for some questions as well. We'll try to keep it fairly conversational, me and Cham, as we go through, and there'll be some slides to speak to as well. So with that, Cham, I might throw to you just to start off talking about the Australian economy, and I guess over the past few years, the real topical areas for any economic chat have been things like inflation and interest rates. So probably a good starting point there.
Excellent. And first of all, thanks everyone for joining. So a good place to start off is inflation, and I guess at a very high level, inflation remains very high in Australia. Well above the RBA's target band of 2 to 3%, but inflation has been moderating from the peak. So we are seeing both headline and underlying measures of inflation start to subside. Now, the RBA would still feel that it's way too high, and that's part of the reason why they hiked rates yesterday. But the trajectory is at least heading in the right direction. But it does seem that it might be some time before inflation does sort of settle back within the RBA's target band.
Okay, yeah. And on that decision yesterday, sorry, we're not done the point first.
Yeah, I'll also just add that while inflation still remains very high, it is moderating. The labour market still remains very strong. So unemployment is still around the cycle lows. It's starting to pick up a little bit as the economy is slowing, but again, unemployment rate of 3.6% is still very much consistent with the RBA's assessment of full employment. And these are levels that the RBA wouldn't be considering rate cuts anytime immediately.
Exactly right. We expect more of a pickup, I guess.
Exactly. That's right. The RBA would probably be counting on unemployment actually picking up before they'd entertain reducing policy rates.
Yeah, so it's been quite resilient, you'd say.
Yeah, exactly.
Yeah. Okay, great. And then so on to, I guess, that decision you mentioned yesterday. What came out of that decision? What was your views and thoughts on it?
Yeah, so I think the key takeaway from yesterday's rate hike was a bit of a dovish hike, even if that does sound a little bit paradoxical. Yeah. So obviously most economists going into yesterday's decision were of the view that the RBA would hike. Market pricing was actually only had about a 60% probability. So the hike wasn't fully priced into markets, but what was probably more important for markets was actually the language in the statement. So even though we got a hike, that wasn't fully priced in, the statement was a little bit dovish. So the RBA added a lot of new language addressing some of the risks, the fact that, you know, the policy does take a little while to pass through, and it did outline, some of the strains that, the household sector might be facing, in addition to some of the global headwinds as well. So even though we've got a hike, the market's, starting to be of the view that the RBA might be done. So, right now the cash rate's at 4.35%, but market pricing is implying a terminal cash rate or a peak cash rate of this cycle at around 4.44%. So that's around a 40% probability of us getting an additional hike in this cycle.
Yeah, exactly. And that's what the chart on screen is showing here. It's showing the market predicting pretty much that those rates have topped out. And to your point, Chum, it's fair to say, or would you say that up until this point, the RBA, when they've been hiking or holding, their outlook statements have been fairly, non-constructive to markets, more fear of higher rate hikes to come. But you're saying this time, with their commentary, it looks like they're finally admitting that, they're going to monitor, but the risk is potentially more to the downside now.
Yeah, potentially. Now, the reason that the RBA did hike yesterday was really about the inflation data coming in a bit hotter than expected. So the Q3 GDP print, the Q3 CPI print came in a little bit hot. Trim mean at 5.2% was a little bit hotter than what both the market was pricing in and what the RBA forecasts were implying. And as a result, the RBA did indicate in the statement that they'll probably have to, revise higher their inflation forecasts over the medium term. And we'll get a more accurate picture of what those forecasts are when the RBA releases their statement on monetary policy on Friday.
And do you have any expectations for that? Do you think that could be, have any meaningful impact on markets or market expectations, or do you think it'll be kind of in line with that verbiage they came out with?
Yeah, I believe it's probably in the price right now, and the market's really been talking about the RBA needing to revise their inflation forecasts higher for some time now.
Great. So moving on from that, I guess, what's been driving rates more broadly in the larger area of chat has been around inflation, which we've already touched on a little bit, but here we've got the inflation forecast as well at the moment. So this is what you mentioned the RBA will be updating shortly.
Yeah, correct. So the dotted line is basically the RBA's prior forecasts that they made in the August statement on monetary policy. So they'll be providing a bit of an update to that on Friday. So it will be interesting to see how the dotted line changes and the date at which they expect inflation to return back to that 2 to 3% band.
And you mentioned an expectation for this to be revised a little bit higher.
A little bit higher, but it might be a front-loaded upward revision.
Okay. Very good. And so I guess, let's dive into then now. That's your real headline, really important inflation, interest rates, headline figures. Let's dive into what's going on under the surface. So starting with the consumer and how the consumer's looking.
Yeah, and this was, maybe a concern that the RBA expressed in the statement that, the consumption side of the economy definitely is slowing, and we are seeing that in the data, both the level of consumption as well as, the rate of change in, household income. And a lot of that, could be simply due to, some of the savings buffers that were built up during the pandemic have, been eroded.
Yes.
In recent times, in addition to obviously the rate hikes that we've had, have also impacted households, especially those with mortgages.
Exactly right. I mean, you can see here, that's what we're showing on screen here. That bottom chart there is showing the huge levels of savings that were stockpiled during COVID, and how those have slowly dwindled away back to, what you'd call normalized levels. And so that buffer that consumers had is potentially gone. And we could start to see a further weakening potentially of the consumer.
Exactly.
Great. And you already mentioned just before how the higher interest rates could also be starting to have effects on the Australian consumer, particularly those mortgage holders. How is that outlook looking? And particularly, I think what's interesting on this slide is how that's affecting different economies at the moment.
Yeah, so these two charts are from the RBA, and the first one shows, the level of policy rates across several developed economies. You can see that in Australia, we haven't had the same degree of interest rate increases as some of our peers abroad. But the thing is, our household sector in particular is a lot more sensitive to the rate hikes that have actually happened, and you can see that on the second chart. So we do have a much faster pass-through from policy rates affecting the interest rates that affect that impact the real economy, and a lot of that is due to the stock of our mortgages, primarily being either variable or short-term fixed, and that's in contrast to, say, the US economy, where the most common type of mortgage is a 30-year fixed rate mortgage, and a lot of US households took out very cheap 30-year fixed rate mortgages a couple of years ago, or they refinanced into very low rates.
Yeah, so what you could say is quite a different transition mechanism, or the way those increased interest rates are ultimately going to affect consumers can be quite different in Australia and the US, and you can see that on the the left-hand chart there, just the level of outstanding mortgage rates for US, the red lines are US, and how low those have stayed due to those long-term mortgages. And we'll probably get more to the US side of things a little later. But for now, if we dive a bit deeper into how the households or how mortgage owners are doing, we heard a lot of media, and we still are, about this mortgage cliff and how high interest rates are going to start impacting the average household with a mortgage. As you mentioned, the majority of our mortgages are that three-year fixed it was before, and those will be rolling off to variable. They've already started to do so and continue to do so over the next 6 or so months. So, what are we seeing in terms of the strength of the consumer through mortgage holders?
Yeah, so we are starting to see, obviously, a slowing in consumption, and that's pretty expected. In terms of like the actual acute squeeze on households, it hasn't really translated to a large pickup in delinquencies or arrears yet. So this is a chart that's showing loans that are 90 days past due, and while there has been an upward trend over the last few years, we're still at sort of very low levels. So we're not at conditions yet that's likely to create much major stress for, say, our banks or our lenders at the moment. But again, you will see a real deterioration in consumption before you start to see it really impact mortgage repayments, for example.
Sure. So you'd expect to, as you said, you'd expect to see other indicators flashing before this, a chart like this or an indicator like this got too poorly.
Exactly.
But you can imagine, though, the RBA investors, the average household will be keeping a pretty keen eye on these types of things going forward.
Absolutely.
Yeah. Great. And so I guess one really interesting and important question then is, we're still seeing and still reading about record house prices in Sydney and in Australia, with certain states seeing huge increase in house prices. So what is that dynamic and what's going on here? And a little bit on that, please, Charm.
Yeah, so it's been somewhat surprising to a lot of people, just given the increase in rates, just how resilient house prices have been. So even at a national level, and even for all the major cities, house prices are at or near their sort of peaks. And when you view it through the lens of affordability, it's even worse. And our chief economist, David Betashares, has done a bit of analysis on this, and according to his work, the average household is probably paying close to 50% of their after-tax disposable income now on mortgage repayments.
Yeah, we actually just speaking to Dave prior to this, and he mentioned for Sydney it's closer to 70% now.
Unbelievable.
So on the affordability side of things have actually never been worse by those statistics. So what is then buoying the Australian property market?
Yeah, so you think with higher rates, that obviously impedes borrowing capacity. It makes debt servicing harder. So it's hard to imagine that demand has been so buoyant. So maybe there's a supply side argument to it, and part of the reason is that there hasn't been a whole lot of construction in recent years, and maybe that there is a lack of supply, especially for houses across the country.
Yeah, I think it's fair to say too, we're fairly centralized in our housing. You know, the majority of the population living in, you know, a small number of big cities, and very close to the coastline. So I think that's, you know, part of this issue too.
Exactly.
Great. And so in terms of what we're seeing for, you know, one of our traditional drives of growth in exports and iron ore prices, yeah, what are you seeing here?
Yeah, so, you know, obviously we've had, you know, fairly disappointing economic reopening out of China, but despite that, iron ore prices have actually remained pretty resilient, and that matters for our economy. It's a big part of obviously our export sector, but it also impacts our terms of trade. So this is, I guess, has been helping counter some of the weakness emerging from the consumption side of the economy.
I mean, could you see this potentially as a risk factor, or you know, what would you see leading to this, you know, potentially, or iron ore prices dropping from this level, and how would that look for us?
Yeah, so a lot of that really hinges on the global economy, and you know, if we were to see, you know, a globally synchronized major downturn, including the US. So far, the US economy has been pretty resilient, but if we saw a major global downturn, then you'd probably see commodity prices, you know, all move lower, which would probably impact iron ore prices as a result.
Okay, yeah, sure. So those broader global risks. And then finally, I think this is finally in the Australian section before we do dive into what's going on in the US and the US resilience, which I think will be quite interesting. Just a broader outlook here too from the RBA forecast. And if I'm not wrong, they'll also update these forecasts along with the inflation ones.
Yes, that's right. So the RBA, even in their statement yesterday, did you know, did say they are forecasting below trend growth for some time. You know, we're already seeing growth quite subdued. And when we say trend growth, we're talking about the level of growth that's, you know, consistent with population growth and productivity growth. So if you think about, you know, the implications of restrictive monetary policy, that is probably to kind of maintain growth at below trend for an extended period of time until inflation comes back within target. And our broad view is that, you know, the Australian economy will probably muddle along. There'll be quite a few headwinds, especially in terms of domestic demand. But at the end of the day, you know, we do think that we'll probably avoid a recession, albeit with fairly low levels of real growth.
Sure, which isn't at all you know, a terrible outcome given some of the forecasts from, you know, last year, or some of the expectations of what would happen if rates did get as high they are at the moment.
Exactly. And you know, in the past, part of the reason that we've avoided you know, recessions that have hit, say, the US economy has been our, you know, the Aussie dollar's role as a bit of a shock absorber for the economy. So if we were to get you know, either domestic driven weakness or globally driven weakness, you know, the AUD could act as a little bit of a shock absorber in that event.
Okay, no, that's good. Okay, guys, so that kind of wraps up. Is there anything else you want to touch on the Australian side, or we can roll forward to the US?
Yeah, look, I'll just add that, you know, I think the RBA decision yesterday will probably be well received by the bond market, and already you've seen bond yields move a bit lower. And I think going forward, our local bond market will probably increasingly anchor on US and global developments, at least over the coming months.
Okay, so more focus on global and US, and maybe less so on RBA decisions. Okay, great. So with that, let's turn globally and look to the US, or the miracle on Wall Street, as we've coined it. So, you know, why have we called it the miracle on Wall Street, Sean? What are we seeing here in the data?
So I guess it's been coined the miracle on Wall Street, given the US economy has been fairly resilient in the face of the most aggressive monetary tightening in a generation. So we've seen the Federal Reserve raise its policy rate from basically 0 to you know, close to 5.5% at the moment. But despite this, you know, the US economy for the most part has actually been fairly resilient. And if you know, the recent Q3 GDP print is anything to go by, it's operating at well above trend levels of economic growth. But what's interesting is when you scratch below the surface, you notice some interesting dynamics. One being that levels of both business and consumer sentiment are actually pretty poor, which is something you don't tend to see during periods of, you know, robust economic growth.
So what do you think the main factor there is then? Why are, despite strong economic growth, consumers and businesses not feeling the love.
Yeah, I think it's all about inflation. The US is still, what you'd say the US economy is still in a fairly high inflation regime, and inflation is really dampening sentiment because I guess everyone feels it.
Yeah. Okay. Sure. I think that covers most of what we wanted to speak about on that side there. So we'll jump forward to the US, or the case for US soft landing. We just talked about our prediction of a soft landing, that non-recessionary landing in Australia. In terms of US, what are you seeing in terms of the outlook for potential recession or avoiding that and having a soft landing?
Yeah, and just to define what we mean by soft landing, it's really this idea of inflation, moderating back to the Fed's target of 2% without, unemployment rising significantly.
Sure, because historically, we've typically seen those two things happen in tandem.
Yeah, so historically, it's often taken a recession and a rise in unemployment to produce the decline in inflation back to target. But there are, signs that, we might achieve what some people are calling immaculate disinflation. But, again, we'll have to wait and see. But some of the signs are positive.
Okay. So what are those signs?
Yeah, the signs are obviously, underlying measures of inflation are moderating in the US. But some of the tightness in the US labor market is starting to ease. So we are seeing, let's say a moderation in job vacancies without necessarily creating a rise in unemployment.
Okay, great. And then, so that's where we're also talking about on this slide as well.
Yeah, exactly. And the key series to look at is hourly earnings. So wages growth was quite high for some time, and we're seeing a moderation, which is something that the Fed would probably like, because again, they probably see wages growth well above 4%, and it's not being consistent with inflation settling at 2%. So they'd want to see a continued moderation in wages growth.
That's right, because there's that fear that if you do get persistently high earnings growth, that's quite sticky. That's what's can be a real issue for the Fed. Let's say that they'd have to really break the back of. But if we see that, as we have started to see, come down without a material increase in unemployment rate, this is this immaculate disinflation.
Exactly.
Oh, great. And then also, looking forward then to inflation or more broadly talking about inflation in the US. What do we have in this chart here, Charles?
Yeah, so this is a chart that looks at a survey of US businesses and their pricing intentions, basically. So it surveys, that captures a percentage of the survey group that's expected to raise prices over the coming periods.
Okay.
And we have seen a moderation in that, and that's probably due to a fall in input costs. But this is also in the past coincided with a moderation in underlying inflation as well. So there are signs that inflation is starting to moderate.
Okay, yeah, we can see here it's obviously quite a long-term chart, but that fairly strong relationship, and 09 is a good example where we saw those expected pricing raises drop off quite significantly and inflation following suit. So I guess what the implication here is, since we've seen those expectations of underlying businesses to raise prices decreasing, you may expect inflation to once again follow suit. So quite a good sign here again for that disinflationary narrative. On that, again, just like with the Australian economy, anything you want to touch on more broadly with the US or the Fed's thinking at the moment?
Yeah, so I think the key point really is about how does this ongoing economic strength change the Fed's sort of reaction going forward. And at the recent Fed meeting, they did suggest that they're probably looking to be in wait and see mode for some time. They're going to be data dependent, and as a result, the bond market has really priced out further rate cuts in the US, and we're starting to see further rate hikes in the US, and we're starting to see some rate cuts emerge in market pricing for the second half of next year.
So that's the market somewhat saying, okay, we're expecting rates for now to stay higher for a little bit longer, but almost believing that what the Fed believes, and that is going to start to have impact, or has started to have impact, and potentially have some cuts next year even.
Yeah, because while inflation remains well above the Fed's target, they'll want to maintain a restrictive stance of monetary policy. So they'll want the the Fed funds rate to be well above their estimate of so-called neutral.
What is that estimate of neutral at the moment?
Well, officially, based on their so-called dot plot estimate in the September FOMC, it's still at 2.5%.
2.5%. So it's quite restricted now based on their.
That's right. Yeah. There's some indications that the Fed might have internally revised higher, or informally revised higher their estimate of the the long-term neutral Fed funds rate. But the key point is that right now, as inflation is high, the Fed will they'll want policy rates to be restrictive. So if we do get a moderation of inflation, back to 2%, then that'll allow the Fed to change their policy setting to, I guess, a more neutral stance. And so that's why the market's starting to anticipate rate cuts over the next 12 months.
Sure. No, it's quite an interesting point. And I wonder, if internally the Fed had revised that neutral rate high, you'd probably expect them to wait until things are more under control to broadcast that to the market because of the impacts it could have in the interim.
Exactly, that's right.
Yeah. Okay, great. Well, then with all of that, we wanted to look at some, investment implications on the back of all the economic data we are seeing, and what better place to start since we've got Sham here, our head of fixed income, with bond yields. I know you're passionate about bond yields, so run us through what we've been seeing, more recently in Australia, and we know the US yields here, but they've been fairly in tandem, right, Australia and the US in terms of bond yields?
That's correct. I'd say overall, the bond market has seen a lot of volatility in recent years. Some of you in the audience might be aware that the bond market, at least global bond market, had one of its largest drawdowns in recorded history last year, and a lot of investors started the year thinking that we've seen the peak in bond yields, but the bond market has had other ideas, so to speak. So, a lot of this was down to the ongoing resilience of the US economy that helped bond yields continue to push higher. And more recently, we've had a lot of, what we call technical factors or supply side factors that have also contributed to this this most recent push higher in global bond yields. Specifically, we've had a lot of issuance from the US Treasury on the back of high levels of government spending out of the US, and we've also had some interesting dynamics out of Japan that have contributed to a push higher in global bond yields. And that matters for the Australian bond market because at the shorter end of the curve, so for shorter term government bonds, they tend to be very sensitive to, I guess, RBA policy rate expectations.
Sure, okay.
But say the 10-year bond yield, it's influenced by a host of different factors, not only what the RBA is doing, but also what's happening in the US.
Okay, so that's why it's important to look beyond just RBA pricing for our market.
Exactly, for long-term government bonds, and for both the Australian and the US 10-year yield, we actually did touch 5% recently, and we've just moderated sort of over the past week.
Yeah, so it's worth mentioning this chart here would be to, you probably know the probably month end, I'd say.
Yeah, I'd say month end.
So as Sham said, after this point, we actually saw bond yields continue to go higher, just over 5% in Australia. And since then, bonds have actually rallied, or bond prices have increased. Those yields have come down a little bit more recently. So a pretty exciting time for fixed income. I guess, talking about, this in context of investment implications, what have you been, seeing, potentially clients or some investors doing at these levels of yields, or how do you view these levels of yields in terms of a investment thesis?
Yeah, so back in 2020, fixed income as an asset class didn't get a whole lot of love due to interest rates and yields being so low. But in recent months, there's definitely been a renewed wave of interest in fixed income, really on the back of these higher yields. I mean, because remember, from an investment standpoint, higher starting yields do raise expected returns out of fixed income. And if you are looking to use, say, bonds as a portfolio diversifier, it does provide a bit more diversification potential in the event of, say, a recession or a real, sharp, deceleration in economic activity.
Exactly right. So almost saying, so we've got high yields now. So investors get, paid a higher starting price for buying into bonds, so can potentially withstand even moves higher in yields when looking at a longer term return horizon.
Sorry, a higher starting income.
Higher starting income, yep, correct. And then also B, since yields are raised, if we did see some form of economic downturn, there is room for them to move lower and provide diversification.
Yeah, and long-term bonds will move on expectations of rate cuts well before they actually happen.
Sure, well. That's a really important point, actually. Great. And then looking to the Australian dollar, I might just throw straight to you on this slide here, Charm. So, what are you seeing in the Australian dollar? What are some implications there? I've seen some questions come through around currency hedging, so we might get to those at the end of the preso, but we can kind of premise the conversation here.
Yeah, absolutely. It's the Aussie dollar is very much sort of at the lower end of the recent range. It did get to a 62 cents quite recently. It's back around 65. Following a rally in over the past week. Look, I think the main reason behind the weakness over the past few months has really been this idea that the RBA has been maybe a little bit behind the curve compared to some other central banks, such as the Fed. In addition, the US economy has been running a bit hotter than the Australian economy, and that's led to a bit of broad US dollar strength.
Yeah.
So the US dollar has been doing well against several other developed market currencies, and the Aussie dollar tends to weaken in an environment of a stronger US dollar, basically. In addition, obviously there's been some headwinds out of China. Their reopening has disappointed.
Yes.
So a lot of these factors taken together have kept the AUD under pressure in recent months.
Yeah, because we typically think of the AUD as a bit of a risk-on currency. That's fair to say. Right. So over the past few years, when there's been some fears of recession, some risk off, and largely, as you mentioned, driven by China, but a slowdown globally, it's fairly common to see the Aussie dollar depreciate against major currencies like the US.
Exactly. And again, maybe we can touch on FX hedging as well. And right now, these are levels that a lot of investors are at least looking to consider hedging out their foreign currency, especially their US dollar foreign currency exposure. So that's something that investors might want to consider as well.
Yeah. So just to take a step back for some of the viewers who might not be as familiar with what currency hedging is. So if we think about it and look for our major, core global equity funds, we typically have an unhedged and a hedged version. So if we use the NASDAQ 100 as an example, we've got the unhedged NASDAQ 100 and then a currency hedged version of the NASDAQ 100. HNDQ is the ticker code on that one. So if you're unhedged, your returns are subject to the fluctuations in currency. And very simply, when the Australian dollar is depreciating against the US dollar, you actually benefit from a currency return standpoint. On the flip side, however, if we saw the Australian dollar appreciate, so let's say it normalized back to its long-term average, which is around 80 US cents, you'd actually expect to see around about a 20% decline in returns just based off currency. So by using a currency hedged ETF, you can offset those currency impacts.
Yeah, so there are pros and cons of currency hedging. I guess one of the benefits is you get the local market return or close to it. And obviously with the Aussie dollar being more of a risk-on currency, if global equity markets are doing well, you get to fully participate in that. Now, the drawback is, you potentially lose some diversification benefits in a period of, let's say, equity market weakness. So if the Aussie dollar was under pressure, then an unhedged exposure might provide some offset if global equity markets are also under pressure.
Yeah, and a great example here, if we look to the chart on screen, you can see, in 2020, during that COVID market crash, if you will, we can see, initially the Australian dollar, being that risk-off currency I've referred to, depreciated quite suddenly with the US, or coinciding with equity markets selling off. So if you were holding, again, the NASDAQ 100, although the NASDAQ had a sharp decline then, the Aussie dollar's decline buffered some of those returns.
Exactly.
Yeah. Okay, great. And then looking more broadly at the long-term returns on the Australian equity market, Charm, you know, how are you thinking domestically about our equity market, and what can you draw from this chart?
Yeah, so this chart here is showing the ASX 200 price index. So obviously returns will have dividends on top of this. But I think the key takeaway is that the index has been pretty range bound for the past 18 months. It's been sort of oscillating kind of around the 7,000 level. So the market has been, you know, moving broadly sideways is how we describe it. And as a result of this, we've seen more interest in equity strategies that don't necessarily depend on, you know, capital gains or price appreciation, such as more income-oriented strategies.
No, exactly right. So, you know, to your point, if you're seeing the capital side of the price side being range bound and sideways, there are, you know, other sources of return that you can get from equity exposure. So, you know, some of our equity income funds, like our covered call strategies, you know, if we're looking at the Australian market, we have our YMAX ETF. And what that does, it holds an underlying basket of, you know, companies listed on the ASX, but it aims to generate higher amounts of income from that basket using an option strategy. So it's fair to say we've seen, you know, clients and, you know, just generally more interest in how to generate, you know, other sources of return outside of just capital appreciation. And then looking more broadly to the global economy, we've got a few charts on screen here, just looking at, you know, the global valuations of equity markets and compared to bond yields. Charm, how are you thinking about things globally?
Yeah, so there's a lot going on this slide, but just to summarize it, you know, earnings globally have been somewhat subdued, including in the US, but valuations have actually been pretty elevated, especially against a backdrop of rising bond yields and higher interest rates.
Fairly surprising, right?
It is fairly surprising. So if I could just draw your attention to the chart on the bottom right. So this compares the earnings yield on the broad global equity market, the MSCI All Country World Index, and you can see that the earnings yield has not risen anywhere near as much as the yield on, say, the US 10-year Treasury bond.
Okay, so the relative rise there between the black and the grey line.
Yeah, exactly.
Sure.
So, and this, you know, has resulted in, you know, what we call a compressing equity risk premium. So the additional, let's say, earnings yield you get on from investing in equities above government bonds has fallen.
Okay.
So that's, you know, consistent with, you know, the global economy avoiding recession, or it's consistent with earnings maybe reaccelerating higher over the next 12 months.
So what that's saying is, you know, in a relative sense, bonds are looking or starting to look, well, particularly compared to, let's say, 12 months or 2 years ago, more attractive from a risk perspective than the equity market.
Yeah, through this lens, yeah, that's yeah, the bond market is looking relatively attractive compared to the equity market.
And then I guess the important question then is why has what has, you know, held up these valuations for equities during this time of slowing growth and general fear and, you know, restrictive policy?
Yeah, so it's one thing to remember that even at the global index level, there's still a decent amount of concentration in the index. US-based mega cap technology companies do make up a meaningful part of the index, and they've seen, you know, their share prices really buoyed by the emergence of, you know, generative AI over the past 12 months or so.
Yeah, okay. So I've heard about this, and also we've talked about this, and it's been in the media quite a bit. How, you know, those 7 largest stocks, the Magnificent Seven, they've been coined by some. So your Microsoft, Apple, Nvidia, Google, they've really buoyed the market, or you know, their price appreciation has really, you know, taken or provided an outsized amount of the global equity market returns, even not just in the US. This has been, you know, buoying equity markets and you explaining some of these fundamentals.
Yeah, absolutely. And I guess this theme of AI is seen as not really dependent on the strength of the global or the US economy.
Okay.
Given, the market is starting to believe that the economy is slowing. And as a result, you've seen a bit of underperformance from the more economically sensitive stocks of late.
Yeah.
The other thing I'll just add is that this idea of, concentration in the global equity market, especially the US market, and the narrowness of leadership is also, meaning investors are now looking for, alternatives to, reduce that concentration risk. And that could mean, looking, outside the Magnificent Seven, or looking even outside the mega and large cap sectors of the equity market.
Exactly right. So I mean, your typical, your typical equity income, or your typical indices, equity indices tend to be market capitalization weighted.
Correct.
Which means the larger the company is, the more weight it has. And since this outsized performance by these, a small number of mega cap stocks, they now take up quite a significant portion of those indices. So to Charles' point, we have seen increased interest both here and also over the US, particularly in trying to diversify away some of that concentration risk. So one of our relevant funds that's definitely worth mentioning then is our S&P 500 equal weight ETF. So rather than weighting the underlying companies by market capitalization, you give each of those 500 companies an equal weight, or 0.2% each in the index. And this just means there's less concentration there. It's a pretty key investment consideration at the moment for a lot of asset allocators.
Absolutely, a lot of investors are looking to reduce maybe their exposure to their single stock exposure to the tech heavyweights, as well as maybe reducing their overall exposure to the technology sector.
Yeah, I guess it's a great complement to those names. And so moving forward, I think we've actually kind of touched on this. We spoke about this previously, but this kind of breaks it down even further, talking about this, outsized or outside performance by technology companies versus the rest of the market. Anything in particular you wanted to draw from this slide, Charm, or discuss?
Yeah, and I'll just say that the outperformance has really been in large cap technology, and this is a segment of the market that's been pretty immune to the rate hikes that we've seen so far. Whereas a lot of the smaller companies are starting to feel the pain of higher refinancing costs creeping in. So this has been one reason behind the outperformance. The other has obviously been the large cap technology has been the biggest beneficiary so far of the generative AI trend. Now the question is, will this continue? A lot of people have been predicting for quite some time we'll start to see mean reversion in performance between so-called value and growth, or the more, let's say, the cheaper stocks or the more economically sensitive stocks versus growth stocks. But this has been this trend of growth outperformance, especially technology outperformance, has persisted for quite some time.
Been over a decade now of this theme.
That's right. And I'd say if we were to see a real change, it would be if we see a real elevated levels of economic activity going forward. If we see higher levels of nominal GDP growth, and that might allow companies and stocks that are more economically sensitive to really rise to the occasion.
Yeah, because as you mentioned too, on two sides of that coin, one, that those more cyclical companies will have more growth ahead of them, and secondly, those large cap tech names, as you mentioned, aren't as sensitive to those economic growth, with things like generative AI pushing them forward.
Exactly.
Yeah, great. So with that concludes the main part of the webinar. Any final thoughts or comments, or happy to open to questions, Charm?
Yeah, let's open to questions.
Sure, sounds good. So there've been plenty coming through. We've already addressed a few of them. While I scroll through them, there's one here that might be interesting to cover. Not an asset class we've talked about yet, but it has been on the mind and of a lot of investors. So it's around how the current economic climate is affecting REITs, or real estate investment trusts. Any comment there, Charm?
Yeah, it's a good question. I mean, REITs have been under pressure for quite some time now, both ASX listed so-called A-REITs as well as REITs globally. And a lot of it has been due to, obviously much higher interest rates. REITs are seen as, almost like a bond-like exposure, so they are quite interest rate sensitive.
Yes, yeah.
So they've been hit by not only higher short-term interest rates, because REITs often use leverage to finance their property purchases, but they've also been hit from the valuation side from much higher long-term interest rates. So that flows through to higher so-called cap rates that impact REIT valuations. The other challenge for REITs has really been some of the headwinds that global commercial property has been facing in the post-COVID environment. So obviously, you're seeing a lot more people work from home. Fewer people are heading into the office, at least compared to say 2019 and before. And that's also potentially impacting top line of REITs. So if you think about REITs are getting the headwind of higher interest rates affecting valuations, as well as challenges around vacancies as well. It's not been a great cocktail for that sector of the equity market.
No, not a good environment there. It's hard to particularly on that the second reason you mentioned in terms of commercial real estate and how how that looks going forward. It's hard to picture if that will pick up, how it could pick up, or how this shifting commercial landscape happens for that. So it could be interesting to keep an eye on going forward. We did speak more broadly about the global economy without getting into anything too specific here. There have been a few questions around geopolitics and how that could affect the Fed funds rate, the RBA, or the broader economy. Any comments there?
Yeah, so I think when you're looking at geopolitics and market implications, I think it's important to look at how it might in fact impact inflation going forward, both inflation expectations and actual inflation. So if we're obviously seeing an escalation in geopolitical tensions. Now, if that were to continue to the point where we start to see energy prices, start rally significantly, that could definitely feed into headline inflation pressures, which could also feed into inflation expectations. And at that point, central banks might have to actually respond with, either rate hikes or guiding towards rate hikes.
Okay, sure. So it's really how it could impact the underlying drivers of inflation would be the main way. Okay, sure. Look, there's not too many other questions. There is one here, and I haven't spoken to you about this in a while, so it'd be good to get your thoughts. But a few questions around the US government debt ceiling, but less sort of debt ceiling itself, but just this this ongoing growth of government debt. There's a few schools of thought here. Some that say it'll grow forever and it'll be fine, and others that say that can't possibly happen. So I won't hold you to account, but any general thoughts?
Yeah, it's a good question, and I was glad it was asked because we didn't actually cover it in the presentation. But I think part of the reason that the US economy has been so strong, and it's a bit of a global outlier in running well above trend growth, especially compared to say Australia, the Euro area, or China. I think some of that has definitely been from these elevated levels of US government spending. So we've seen some big spending bills passed of late, namely the Inflation Reduction Act and the CHIPS Act. And these bills have definitely gone a long way to reducing the US economy. So however, it's also resulted in obviously a big increase in US levels of US public debt. And we're almost in uncharted territory to see such a large deficit so far into an economic expansion. So I think the US budget is currently running at around 6%. Budget deficit is currently around 6% of GDP. It was as high as 8% quite recently, and the aggregate level of debt is now around 33 trillion. So elevated debt is definitely being talked about increasingly by the market, and it has actually impacted the market through bond yields rising on the back of elevated levels of government issuance.
Exactly right.
Of bond issuance, I should say. So it's something to watch out for going forward. I think ultimately what really matters is the impact it'll have on inflation over the longer term.
Okay.
So if we see this elevated level of government spending continue, then that could force, inflation to be structurally higher,
Mhm.
as well as interest rates to be higher for longer.
Yeah, it's quite interesting. As you mentioned, you've got that still quite expansionary budgets and fiscal side, while you've got quite contractionary monetary policy. And I guess another consideration there is also servicing costs on that government debt with interest rates at the levels they are at.
That's right, and that will also have an impact on corporate borrowers because you've got obviously quite high levels of corporate debt that has to be refinanced over the coming years. So there is, a potential risk that elevated levels of US government issuance could potentially crowd out the private sector.
Yeah,
or corporate borrowers.
There you go. Very interesting. Look, with that, I think we've covered most of the questions that have come through there. Unless there's anything else, Sham, you want to conclude with, we can probably wrap up there.
Sounds good.
All good. Thanks very much, and thanks everyone for attending. As mentioned, we'll send around a recording after the webinar.